Hello folks, my name is Gian Pazia, and today I will be explaining the estate planning strategy using cost segregation. For this strategy, let's start with some basic rules related to estates that involve real estate. When a building owner dies and a property is inherited that has been appreciated, any gains built up during the decedent's life are forgiven. The beneficiary receives a step-up, which means the property's tax basis is reset to fair market value on the date of death, and depreciation starts all over again. This provides an opportunity to apply a cost segregation study on the decedent's pre-stepped up basis, creating a permanent tax deduction. To illustrate this, let's look at a building purchased by a decedent in 2008 where the death happens in August of 2015. Since the original investment of $1 million is considered residential rental property, it's depreciated over a long life of 27.5 years. So by the time of death, the decedent will have roughly $728,000 of depreciation he never got to deduct. The decedent will still need to have a final tax return prepared for the period in 2015 he was alive. Now, supposing the decedent had sold the property for $2 million before he died, he would have had a taxable gain of $1.27 million. Now, that doesn't happen in our situation since the current estate tax rules forgive any taxable gains built up by the decedent. The beneficiary gets a full step up to fair market value of the property on the date of death, in this case, up to $2 million. And then the beneficiary can record that $2 million basis on their tax return going forward. Now, most CPAs already know that doing a cost segregation study on the $2 million stepped up value is a great idea, but many CPAs overlook the time-sensitive opportunity to apply a cost segregation study to the pre-stepped up basis of the decedent. This allows the decedent to claim even more depreciation deductions before the death, lowering the building's tax basis and creating a higher step up to fair market value. So the idea is to take as much depreciation before the death as possible, since the heir is going to get a step up to fair market value regardless of what the decedent's tax basis is. And this strategy typically yields the greatest benefits for estates because these deductions would otherwise be lost forever if not taken on the decedent's last tax return. So let's look at a case study to illustrate. When we conduct a cost segregation study on the building as of its 2008 purchase date, we identify items in the building purchase price that should have been depreciated with shorter depreciable lives. Since the decedent should have written these off over a much shorter life than 27.5 years, the IRS allows them to claim any missed deductions on his final tax return using a Form 3115. In our case study, when the decedent's final tax return is filed along with that Form 3115, they claim missed depreciation deductions of approximately $174,000. This lowers the decedent's building's tax basis, but that's okay, since the heir gets a step up to fair market value regardless of the decedent's basis. Because these deductions would have been lost forever, the result is a permanent tax savings just over $68,000. Now, I mentioned that this needs to be done on the decedent's final tax return. That's because when a building is acquired in a tax year prior to death, in order to apply a cost segregation study, a 3115 is required and generally cannot be filed on an amended return. And then, of course, after the step up, the heir has the option to apply a cost segregation study to their $2 million basis. And that summarizes the strategy. For more information about this tax strategy that was published by the AICPA'S tax advisor, follow the link to our website where you can read the entire article. For detailed questions, you can always contact me directly, and I'll be happy to help. Thanks, everyone.